This trade lost. Same indicator, same rules, same 15-minute chart, but I made a mistake, and I will show you exactly where. These three worked. By the end of this video, you will know the difference. No theory in this video, no back-tested screenshots. 4 live trades, 4 different charts, 1 strategy, 15-minute candles. Stop loss and take profit on every single entry. Risk to reward is 1-to-1, so 1 loss cancels 1 win, nothing more. Let me show you the rules first, then we take the trades together. There are only 3 things I look at. Rule 1, the trend line. This dotted line follows the market direction. When it is rising, I only look for buys. When it is falling, I only look for sells. That is the filter. Nothing else gets traded. Rule 2, the arrow must agree with the line. You will see arrows in both directions. Most of them are noise. An arrow pointing against the trend line is not a signal for me. I ignore it completely. Only when the arrow and the line point the same way, I get interested. Rule 3, where the signal appears. These horizontal zones are levels the market has already reacted to. Some are marked as verified. Price has come back and respected them before. Some are untested. Price has not proved them yet. A signal at a verified zone is worth taking. The same signal in empty space is worth skipping. Same 3 checks for a sell. Line falling, arrow down, signal at a zone that has held before. Stop loss goes beyond the last swing. Take profit at 1-to-1. That is the whole plan. Before we go to the charts, 30 seconds of honesty. Everything you are about to see is my own trading. It is not advice, and it is not a signal service. Whatever you decide to do with your own money is your decision. This strategy will not win every time. You are going to watch one of these 4 trades lose, and that is not the worst case. The worst case is a run of losses in a row. That happens to every method, including this one. So 2 rules before you try this. First, test it on a demo account until you have seen it fail and you still trust the rules. Second, never risk money you actually need. Trading carries real risk, and losses are part of it. If you are still with me, let us go to the live charts. First chart, 15-minute candles. Look at the dotted line first. It is rising, and price has been holding above it for hours. So the direction is decided. I am only looking for buys here. If a sell arrow shows up on this chart, it is not my trade. Now look at the green line just below price. This zone is marked as verified. Retest count 1. That means price has already come back to this level once before, and buyers defended it. That is not a random line I drew. The market has proved it. And here is the arrow. Buy arrow, pointing up, sitting right at that verified zone, with the trend line rising underneath it. All 3 conditions agree. That is my entry. Now the part most people skip. Before I click anything, I place the box. Stop loss goes below the verified support zone. Not a few points below price, below the level itself. If buyers fail to hold that zone, my reason for being here is gone, and I want to be out. Target is the same distance on the other side, 1-to-1. The tool shows the ratio for me, so there is no guesswork. One quick note about this box. This long and short position tool is a paid tool of mine. It is on my website. Everything else you see on this chart, the candle timer and the support resistance zones, those are free and the links are in the description. Buy is placed. Now we wait. Price is moving up slowly, nothing dramatic. But watch this. A sell arrow just printed while my buy is still open. This is where a lot of traders panic and close early. I did not touch it, and here is the reason. The dotted line is still rising. That arrow is pointing against the direction. By rule 2, it is not a signal for me, not to enter and not to exit either. My exit was already decided before I entered, either the stop or the target. An arrow in the middle does not change that. If you start closing trades on every opposite arrow, you will cut your winners short and keep your losers full size. That is how a 1-to-1 plan stops working. Target hit. Price pushed through and closed the trade at the level I picked before entering. 1-to-1, exactly as planned. Notice what actually made this trade work. It was not the arrow. Arrows appeared all over this chart today, in both directions. What made it work was the arrow appearing at a level that had already been defended, in the direction the trend line was pointing. The arrow was the trigger. The zone and the line were the reason. Keep that in mind for the next chart, because the setup there looks similar, and one of the trades ahead is the one I lost. Different chart now. Same three rules, but this setup is not as clean as the first one, and I want you to see why. Look at the dotted line across this chart. On the left, it was falling. Sellers were in control. Then it flipped and started rising, and it has been rising ever since. So direction is fine. Buys only. Price pulled back to the rising line and printed a buy arrow. Arrow agrees with direction. Rule 2 is satisfied. Now Rule 3, and this is where it gets weaker. Read what this level says. Untested support. Not verified, not proven. Untested. That means price has not come back to this level and defended it yet. It is a level I expect to work, but the market has not shown me proof. Compare that with the first trade, where the zone said verified with one retest. That was a stronger setup. So why am I still taking it? Because the other two rules are strong and the box makes sense. Stop below the untested level, 55 points. Target at the proven support level above, 58 points. Ratio just over 1-to-1. But I want to be honest with you about the grade of this setup. It is a take, not a favorite. Now look how long this took. Entry was in the evening. This screen is the next afternoon. Roughly 21 hours in one trade. This is the part nobody shows you about the 15-minute chart. You are not scalping here. You place the trade, you set the stop and the target, and then you leave it alone. And in those 21 hours, 2 sell arrows printed while my buy was open. Same answer as the first trade. The dotted line never turned. Both arrows were against direction, so both were noise for me. If you sit and watch every candle on a trade like this, those 2 arrows will talk you out of it. That is exactly why I decide the exit before I enter, not during. One more thing. Another buy arrow printed here, in the same direction, while I was already in. I did not add to the position. One signal, one trade, one risk. Stacking positions on the same idea is how a 1-to-1 plan turns into a much bigger loss. Price pushed into the proven support level above and the target was reached. Second trade closed in profit, 2 for 2 so far, but look at what actually happened here rather than the result. The weaker part of this setup was the zone, untested, no proof behind it, and the trade still worked. That is not luck, and it is also not a reason to relax the rule. What carried this trade was the direction. The line was rising, the pullback came into that line, and the arrow fired in the same direction. 2 strong conditions covered one weak one. Remember that, because in the trade that I lost, it went the other way round. Third chart. This is the trade I lost, and I am not going to soften it. The mistake was mine, not the indicators. On the surface, everything looked fine. The dotted line was rising. A buy arrow printed. There was a level right under it. 3 ticks, done. But look again, properly. Where is the dotted line? All the way down here. Price is sitting far above it. Now compare that with the 2 trades you just watched. In both of them, price came back down and touched the rising line, and the arrow fired right there. That pullback is the setup. It is the whole reason the stop can sit somewhere sensible. Here there was no pullback. Price had already run, and I bought into strength instead of waiting for it to come back. Second problem. Look directly above the entry. Untested resistance, and it is close. That means my target had to be placed at a level the market had not broken yet, only 18 points away. On the previous chart, I had almost 60 points of clear space. Here, I had almost none. I still took it. That was the decision that cost me. And watch how quickly it turned. Look at the dotted line now. It has flipped. It is coming down through my entry. This is the market telling me the direction I bought into is no longer there. On the first 2 trades, the line held its direction for the entire trade. Here it changed within a few candles. The stop was 18 points away. On a pair like this, 18 points is normal movement. It is not really a stop based on structure. It is a stop based on how small I wanted the risk to look. That is a mistake worth naming, because a lot of traders make it. If the level forces you into a tiny stop, the answer is not to take a tiny stop. The answer is to skip the trade. Stop hit. 1 loss. And this is why I set the risk to reward at 1-to-1 before any of this started. This loss cancels one of the wins and nothing more. No revenge trade, no doubling up, no moving the stop. Now here's the actual lesson, and I want you to compare the three charts side by side. On the first chart, all three conditions were strong. Verified level, clean direction, arrow at the level. On the second, the level was weak, but the direction was strong, and price pulled back to the line. Two strong conditions covered one weak one. On this one, the direction looked fine on paper, but price never came back to the line, and the target was blocked by resistance right overhead. Two weak conditions and nothing to cover them. So the rule I would give you is not take every arrow that agrees with the line. It is this. If more than one condition is weak, there is no trade. The arrow will still print. You just do not have to click. One more chart to go. Last chart and the first sell of the day. Same rules, mirrored. The dotted line is falling across this whole chart. So sells only. Price rallied back up into this level, a support that broke earlier and is now acting as resistance. And the sell arrow printed right there. That is the pullback I was missing on the last trade. Price came back to the level, the arrow fired against the rally, and the direction agreed. Stop above the level, 20 points. Target 20 points below. 1-to-1, as always. Price rolled over almost immediately and worked its way down. Two more sell arrows printed along the way. I did not add. One signal, one trade. Target hit. Last trade closed. So that is 4 trades on 4 charts. 3 worked, 1 did not. And the whole difference sits in one thing. On the 3 that worked, price came back to the line before the arrow appeared. On the one that failed, it did not. I bought after the move had already run, into resistance sitting right overhead. So if you remember nothing else from this video, remember this. The arrow is the trigger. The pullback to the line is the reason. And if more than one condition is weak, there is no trade. About the tools on this chart. The long and short position box is my paid tool. It is on my website. The candle timer and the support resistance zones are free, and the links are in the description. I have also put the rules of this strategy into a short PDF, including a one-page checklist you can keep beside your screen while you trade. That link is in the description as well. One last time, this is my own trading, not advice, and 1 loss out of 4 is not a promise. Test it on demo until you have seen it fail and you still trust the rules. If this helped, subscribe. I will see you on the next chart.